For a majority of Americans, paying off their mortgage is a lifelong dream, one of the biggest financial purchases you will ever make. And of course, if you carry it for 30 years, you will almost pay for your house 3 times in its entirety, depending on your interest rate. Now, in today's video, we're going to be looking at 12 things to do to become mortgage-free sooner. So being able to be debt-free, Dave Ramsey style, not having anything at all. And most of these I have used myself, starting with number 1, making larger monthly payments. Now, this is massive, especially if you are just starting out with a new mortgage. When you have 30 years left, a majority of the interest that you're paying is going to be front-loaded because, of course, it is based on the higher balance. So essentially, anything that you can put down, 50, $100, you can actually make this add up over time, cutting literally years off of your mortgage, which is kind of crazy. They have the old kind of mantra, if you can make one extra payment every single year, chances are you can cut about 5 to 7 years off of your mortgage, again, depending on the rate. But you have to know what you're getting into before you start making these extra payments. Because of course, consult with your mortgage company, make sure there is no prepayment penalties or extra payments can be accepted. Some companies will actually take your payment, just hold it to the side, never apply it to anything until it is a full payment. Now, making an extra payment, make sure you know that it is being applied to principal, that it's not going to your next monthly payment. And of course, be careful not to get sucked into the mortgage acceleration programs. Biweekly payments can be focused without even doing biweekly payments with really a focus of intention and also attention. And overall, if you're in biweekly, you're locking yourself into making those extra payments with things in the market and things that can happen in the economy. Want to make sure that we're not locked into those. And again, you can systematically just do it yourself by making the payments yourself. Number 2, we get into when the rates are low, like we've seen in 21 and 22, make sure you refinance. There is a break-even calculator when it comes to mortgages, making sure you're refinancing because of course you're going to have to pay closing costs again. But let's say you're going from a 7% to a 4% or a 5%, chances are with a conventional mortgage, if you are making the adjustment to a much lower rate, you can save a lot of money. Now, at this time, you can also look at getting an even lower rate, not going back to a 30 years. So what I mean by this, if you're in a 30-year mortgage, let's say you're 5 years down, so you've got 25 years left on this mortgage, a lot of people do a refinance at a lower rate. They will take it back to a 30-year mortgage, which essentially means if you're staying in your house in the entirety, you're already going to be staying there and paying on this mortgage for 35 years. Now, granted, a lot of people only look at the payment and the payment only is the really driving factor. You want to make sure that, again, you're not paying tens, if not hundreds of thousands of interest on the mortgage that you have, and you're really knocking out that principal. Number 3, we look at making a lump sum payment. This could be an inheritance. It could be a lotto winning. It could be a tax refund. There are a multitude of things. And again, making sure that if you're throwing it on the mortgage, it is going towards principal because essentially, let's say you put $10,000 on your house at principal. Let's say it's at 7%. Boom, you're already going to be cutting off a multitude of months and saving almost $22,000 in interest. That's right. You put $10,000 in, you save $22,000 in interest, which for me is an absolute win-win. Number 4, pay down the mortgage before you buy a house. Now, this is something that people don't seem to do anymore. And what we mean by this, yes, you can. The way you do this is the down payment. That is right. Not only can you avoid PMI by putting that 20% down, but you are kind of prepaying the mortgage before you buy the house. Now, what we mean by this specifically is if you're getting into mortgage, let's say your mortgage is $1,300 a month, put $1,300 a month away, knowing that that mortgage is coming. That is going to be built up essentially for your down payment because the way you have to look at it is every single dollar that you don't have to borrow is a dollar that you are not paying interest on. Number 5, living below your means. That is right. This for a lot of people is really a wake-up call as things continue to get more expensive. People are living well outside of their means, which makes it incredibly difficult to do anything else. So a couple ways to do this: budget your groceries more carefully. This might be eating in a lot more, making sure that you're kind of discount shopping, looking at stores, looking at sales, looking at really what is coming up and how you can cut your costs. You may want to look at some subscriptions. For a majority of people, they are saying about $212 a month in subscription costs is the average for Americans. So seeing not only ones that you can live without, but also looking for ones that you are essentially not even using, that is going to allow you to put that excess cash right into that mortgage payment. Reducing your energy consumption. LED lights, looking at your thermostat, making sure that you're really cognizant with your monthly bills and exactly how you can lower them. And of course, the really big one, the homeowner's insurance. Take a look every single year at your homeowner's insurance. Make sure that you get the best quote for the coverage that you need and that you're not overpaying essentially for the same insurance that you can get elsewhere. The number 6, live on 50% of your income. This again is an old school rule. If you live on 50% of your income, your life will be nice. When we think of the 50-30-20 rule, when you start living on less of your income, or essentially, even if your income does increase, you don't increase your spending. It is kind of crazy how much debt you can knock out, how much more of a mortgage payment you can make when you're putting not just, $50, $100 here, but if you're putting hundreds of dollars or even thousands of dollars into that mortgage every single month, you're going to pay it off exponentially faster. Once you're mortgage free within about 5 to 10 years, then guess what? You don't have to pay for it again. It is literally gone, which is awesome to see, saving you a ton of money. Number 7, getting a roommate, renting out a portion of your home. For a lot of people, this is huge depending where you live. Spare bedrooms can go for $1,000, if not more, when you look at being able to pay for your mortgage, even if you have a roomie or you have a tenant, even if it is just short term. Essentially, you can snowball that payment that is going into, or that is being essentially provided by your renter, back into the mortgage, being able to pay it off much faster. Now, of course, like me, you could start a side hustle. YouTube is the side hustle we're working on. So if you're liking the content that I'm putting out there, definitely consider subscribing to the channel. Let me know in the comments. Side hustle is a great way to make extra cash, not only debt consolidation, but investing and also putting that side hustle money right into the mortgage. Me personally, with all of our YouTube revenue, we are putting it into the SCHD. That is what we voted on. So essentially, I'm getting income from revenue from the AdSense. All of that money is going into an investment account. That investment account is generating dividends to Compile. So as I continue to put more money into that investment account, me personally, I'm going to be seeing more and more dividends from the SCHD, which is cool. But of course, in this case, you could also put that towards your mortgage. Number 9, very similar to the side hustle, is getting a part-time job. Again, even if this is, let's say, just a couple hours a week, even if you're earning, $20 an hour, 10 hours a week, that's an extra $2,000 that you're throwing at your debt, extra $2,000 that you're throwing at your mortgage, being able to come mortgage free a lot faster. And also for a lot of people, number 11 is downsizing. For a lot of people, they have a lot more house essentially than they don't need. Might have been a point in time where you had, a kid, 2 kids, 3 kids. You needed the multitude of bedrooms and you've outgrown it. You've kind of gotten to needing a less expensive housing kind of situation. That is a great way where if you have a house that has a considerable value, you're moving to a smaller or downsizing your home to a much easier payment. You can take a majority of the equity you've built and put it onto your other one. And of course, unfortunately, I forgot number 10, which is asking your friends or family for help. That is right. If you are struggling with mortgage payments, there are a ton of different places, not only family and friends, but there are also state programs, there's city programs, there's local programs. You want to make sure that you're not falling behind on these mortgage payments because, again, it starts to snowball if you can't make the payment. Then your interest can be adjusted or changed. And then, of course, there can be fees, there can be late fees, there can be a lot of other stuff. And if you're not ready to own a home yet, or if you're not really built into it or don't want to, you could also consider government-backed programs. For a lot of government-backed programs, when you look at VA loans, the USDA loans, the FHA loans, a lot of people can get into houses that don't think they can. And a lot of times those houses that they're getting into are much cheaper than they're actually paying rent. Even right now, what we're seeing in my market is that when you're looking at a conventional mortgage right around $200,000, even at a 7% over a 30-year, you are paying almost the exact same systematically that we're seeing in rent right now than you would be paying on the mortgage. Now, of course, a house is going to come with a few extra expenses as far as the utility piece, but it is also going to come with the ability to actually build equity in there. So guys, that is going to do it for today's video. The 12 things to do to become mortgage free sooner. Let me know in the comments what you guys think. And as always, thank you guys for watching.